So recently, a client came to me. He had banked with a Big Four bank for the last 40 years, a strong asset position, had purchased a property. With 1 week to go, the bank said they can't help him. So he needed to look for an alternative. He came to me and he told me his situation. So what I did was I had to go to market and understand the type of loan that he could get within a week, understand all his properties that were specialized and rural, and work with a lender that was able to deliver an outcome within a week, and that was a private lender. So the incumbent bank was unable to help. Client needed a solution, came to Peak Capital, and we were able to provide that. Now the rate was more expensive, but ultimately the client did not lose their deposit when purchasing that property. So with the rates going up, businesses need to assess their current cost of borrowing, what their future plans are, and what the future cost of borrowing is going to be as well. Now, if the business maintains its revenue, is profitable, rates going up is going to have less of an impact. But with rates going up and having a B2C business, if the consumer stops spending and their revenue decreases and their interest costs increase, that might cause an issue within the business. So businesses need to understand future demand for their product, understand their future finance requirements, and work out what revenue or profitability looks like in 6 months' time, in 12 months' time, and make decisions today for the future. And that is future planning within a business. The biggest shift in recent times or recent event was COVID, because that created a lot of liquidity in the market. So all banks were given a lot of money from the government and said, go lend this money. Now what that did was obviously caused inflation. And now we're in a stage where, hang on a second, we need to bring that back. So with rates going up, there's going to be less consumer demand. There's going to be higher borrowing costs for businesses. So now we get into a tricky period for businesses. We need to understand their pre-COVID numbers, their numbers during COVID, and now their numbers looking forward as well. So we just can't rely on 1 year in isolation. We need to understand what the business can achieve moving forward, and probably need to average out the last few years to work out what the true demand is for their services. And by understanding that, we're going to be able to provide the right finance solution from that large event. The fluctuations in the Australian dollar can impact the business in terms of the price of its goods. Now, a weaker Australian dollar means their goods are getting more expensive and they need to pass that on to the client. A stronger Australian dollar means that the goods are cheaper and then they can pass on that saving to the client as well. The RBA has been one of the last countries to move in terms of rates, so it's catching up to the rest of the world. The Australian dollar needs to be considered for a business, especially importers and exporters, to understand where it currently is, at what price does it factor in, at what exchange rate it prices its products. In my opinion, the best strategy is to be forward thinking. So you can't be looking backwards, you need to be looking forwards. You need to understand what the demand for your product is, where your next sale is going to come from. Do you have the right systems and processes in place within your business to achieve your goals? So with rates going up, what might have been a deal for a bank 12 months ago, 18 months ago, is no longer a deal for a bank. And that's because the client does not meet the servicing requirements that the bank has, or an interest cover ratio. So what that has caused is a shift from bank to non-bank or private lending.